see a very clear trading theme so far in the Asian session. How long does the risk-off sentiment last for? What are the biggest kind of casualties that you see as we see really kind of an interesting dynamic here when it comes to dollar demand in particular?
So we're just a few days into kind of a once-in-a-lifetime reorientation in the world order. So that this transition is not going to be a smooth one. So we simply have to accept that uncertainties will remain very high in the next few weeks. And that will be the story of volatility for the markets, for the next few weeks, if not months and quarters. In terms of the situation in Ukraine, which is essential here, for the markets, it's increasingly clear that Russia has not been able to exploit the initial shock and awe attempt into meaningful tactical gains. There's now an overwhelming argument in favor of a negotiated settlement, but we have to assume that new attempts will be made again at seizing the upper hand, despite the setbacks, as Moscow has more or less staked its credibility and thus, potentially a stability on this invasion. So this suggests that we're still in the early innings of the conflict. And we as investors, hope for a quick resolution of the situation, but we have to be humble here and acknowledge that the scope for even more troubling escalation in and outside Ukraine remains open. For sanctions, we now have an extremely punitive combination of economic and financial restrictions being applied to Russia. But we will have a period of significant hardship for the Russian economy and additional disruptions in the global supply chain. And under our assumption of lack of negotiated settlement, we still expect a crisis-like condition in Russian economy, shock to global growth was, 40 to 50 basis points, and further rise in inflation. So for the markets, we now have a situation where the most essential buyer of the Russian ruble is missing from the currency markets due to the new freeze on Russia's central bank. So we'll see some dramatic days for the currency markets for sure, but for the Asia markets, of course, we'll continue to have to grapple with the significant disruptions of the global trade and the pressures on the global supply chain. So visibility is very poor, and we're set for still, at least a few more weeks of volatility in the markets, for this week.
That visibility is very poor, and that's key for central banks as well as they look to kind of work out what their next steps are. I mean, I want to take you to our question of the day on our MLive blog. It's how long before the next global recession? We already know that those risks were building if you take a look at the flattening of the Treasury curve and also the moving forward of potentially the next Fed rate cut, right, as we see the kind of increased hawkishness. Does this really heighten the risks of a policy mistake and potentially move forward that anticipation of a recession? So
we think one of the new things about the Fed's policy framework, and maybe to a lesser degree the other central bank, is that they're quite more flexible compared to the previous rate hike cycle. So we really don't think assuming a degree of inertia for Fed's rate hike is the right thing to do at this juncture. We think they're quite open. So right now, inflation fight is the main goal, and this is why many central banks will start tightening this year. But next year, we cannot simply assume that the same pace of hike will continue. And in fact, bond markets are already looking through this episode, and as you said, pricing a degree of potential stagflationary or recessionary outcome on the horizon. If you look at the U.S. yield curve, for instance, if you simply look at the 1-year forward, a 2-year forward yield curve, it's completely flat. So already there is a pricing for geopolitical disruptions as well as potential policy gridlock in D.C. And the impact of tightening that will be done this year. So in our view, the tightening is definitely the story this year, but we shouldn't assume too much and extrapolate too much, for the next year. And so that's one kind of key mantra that we have as we go forward.
Homin, you're going to get a lot of calls today, a lot of calls. And earlier we were speaking with Mark Cudmore from our MLive team about the search for liquidity, that's all that's going to be on investors' minds over the next few days. Is there enough of it out there? Will we have to see banks stepping in and offering swap lines and all sorts of crisis-era instruments?
That's the central question for the markets, especially today, because we have a situation where the usual lender of dollar liquidity is certainly missing from the markets due to this new restriction on Russian central banks. Our thinking here is that this will require some reaction from key central banks, including the Fed. So for the global markets to kind of, to navigate this environment, they will require, for the U.S. domestic markets, the use of standing repo facility. For the FX markets, it's probably necessary that the FX swap lines and the FEMA repo lines are now open for the other central banks to use. So that's potentially a decision that could happen as early as today. So we'll keep watching that development.